Let's move on to discuss the underwriting process. Underwriting is a crucial component of the mortgage process that dictates whether or not a borrower will get final loan approval. Underwriting is the process by which the lender verifies the borrower's income, assets, debt, and property details in order to issue final approval on their loan application. A mortgage underwriter is responsible for analyzing borrower risk to determine if loan terms are acceptable. The underwriter will investigate to make sure that a borrower's application and documentation are truthful, and they will also double check that they describe their finances accurately. Mortgage underwriting standards have become more stringent thanks in large part to CFPB requirements enacted in the last few years. These enactments require mortgage underwriters to look closely at the applicant's employment and financial history before approving a loan. Depending on the lender, the mortgage underwriter may be part of an in-house underwriting team or a separate processing or underwriting company that the lender uses to outsource the underwriting process. The underwriting process may vary slightly among lenders, who can delegate responsibilities to originators, processors, and underwriters accordingly. That being said, let's move on to the factors of consideration for loan approval. It does not matter if a loan is being underwritten manually or through an automated underwriting engine. The following 3 C's are the foundation of most underwriting evaluations. And let's remember that another name for underwriting is risk analysis. The following 3 factors are typically used to determine the approval or denial of a loan application. The first is capacity. This is the borrower's income and assets, which will help to determine the borrower's ability to repay the loan. The second is credit. This is the borrower's credit history, which demonstrates the borrower's willingness to repay debts. And finally, there's collateral. This is the property value, which indicates whether this extension of credit secured by this collateral is a wise financial decision for the lender. When evaluated together, these factors will present a general picture of the risk and potential profit to be made by extending credit to this particular borrower for this particular property. Another factor which could represent a compensating factor in the underwriting process is the capital or cash reserves that a borrower has available. A reserve is equal to 1 month's payment. So, if after the closing, a borrower had $10,000 left in the bank and had a $1,000 monthly payment, that borrower has 10 months reserves. This brings us to automated underwriting systems. Automated underwriting systems. Say that 10 times fast. Earlier, we mentioned that the underwriting decision can actually be made by an automated underwriting system. Many lenders have their own systems, but if a loan is going to be sold to either Fannie Mae or Freddie Mac, it will run through their own proprietary system. The creation of the automated underwriting system has radically transformed mortgage lending. With the advent of these systems, an originator can upload the information about the borrower into an online system and receive an underwriting approval within the matter of moments. The automated underwriting system will make the approval based on the assumption that the information entered is correct, and will then condition the generated approval upon the verification of the information using the methods that we just discussed.